This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 20, 2026, and this is the New York session. Now, let's get into it. Markets are locked in a state of extreme distress, with the Fear and Greed Index plunging to 14 out of 100, a reading that signals pervasive investor anxiety. Yet, instead of a chaotic crash, we are seeing a rigid bifurcation. Safe haven flows are funneling into the US dollar and gold, while risk-sensitive assets struggle against the weight of sticky inflation. The dollar is mixed at best, but the structural pressure on central banks is creating an environment where geopolitical mediation attempts are being completely overridden by monetary reality. Looking ahead, the immediate data pipeline is quiet, shifting our attention entirely to the structural backdrop rather than scheduled releases. The next major macro event to monitor is Thursday, July 23rd, when weekly jobless claims will be released. This is the first significant labor market test since the latest CPI print, and it will serve as the critical stress indicator for whether the current 3.63% Fed funds rate is sustainable. Beyond that, we look toward the July 27th GDP Now estimate, but for this session, the focus is on the existing data architecture holding firm.
And that jobless claims release on the 23rd becomes the litmus test for the higher for longer narrative. If employment data softens while CPI remains at 3.46%, we could see a crack in the dollar's defensive wall.
To understand the current gridlock, we need to look at the core metrics driving this session. As of 9:29 ET, the Fear and Greed Index is deeply fearful at 14/100, while the VIX sits at 18.77, showing a modest increase of 2.4 points, but remaining surprisingly low relative to the panic in equities. We have a complex interplay of data points. Gold is trading at 4,025.13, up 0.74%, yet headlines explicitly note it is under pressure due to rate hike risks. Meanwhile, the US dollar is showing selective strength, with dollar-yen at 162.368 and euro-dollar at 1.1442, both pushing against their respective 5-day highs. The director's brief notes a structural disconnect where sticky inflation at 3.46% has locked the Fed into a restrictive stance, making mediation news irrelevant to price action. Let's run through the headlines shaping this environment. First, mediators have proposed a 10-day cessation of strikes to find ways to revive the US-Iran deal. Second, oil prices ease a bit after Iran's foreign ministry spokesperson suggests diplomatic efforts are continuing. And third, and perhaps most critically for our asset allocation, gold stays under pressure as the US-Iran crisis keeps inflation and rate hike risks elevated.
That third headline is the key. You have a 10-day ceasefire proposal intended to lower risk premiums, yet gold is under pressure because the market is looking past the geopolitical noise to the underlying inflation data. The VIX at 18.77 suggests options traders aren't pricing in a volatility spike from the Iran situation, but the Fear and Greed Index at 14 tells us spot investors are terrified. That divergence is where the pain is hiding.
It's not just pain, it's irrelevance. The headline says gold is under pressure due to rate hike risks, which confirms my base case. With CPI at 3.46% and the yield curve flat at 0.37 percentage points, the Federal Reserve simply cannot cut rates. The mediation news is drowned out by the math. Capital isn't fleeing to safety because of war. It's staying in dollar and gold because real yields are still attractive enough to cap the upside.
And that attraction is overcrowded. The reason gold is struggling despite the fear narrative is because leveraged funds have dumped billions into yen and euro shorts. When everyone is short the same side of the boat, any stabilization in the US dollar stops the bleeding but doesn't spark a rally. The pressure on gold is really a function of crowded carry trades refusing to unwind unless yields drop, which they won't.
Let's dive into the technical structures driving this session, starting with the two pairs pushing hardest against their boundaries, dollar-yen and euro-dollar. Dollar-yen is currently at 162.368, just 0.23 pips away from its 5-day high of 162.597. Euro-dollar is at 1.1442, testing the 1.14826 resistance ceiling. How are we interpreting these levels?
This is textbook breakout compression. In dollar-yen, the price is hugging the upper bound of its consolidation channel. At 162.368, we are essentially touching the ceiling. A decisive close above 162.6 would invalidate the recent range and trigger algorithmic momentum buying. Similarly, euro-dollar is resting at 1.1442, challenging the 1.14826 barrier. The lack of pullback suggests absorption of supply. If these levels hold, we are looking at a continuation of the dollar strength theme, not a reversal.
I have to push back on the idea that this is a clean breakout. Look at the COT data for yen. Leveraged funds hold a net short of 90,461 contracts, having added nearly 92K contracts in a single week. That is not organic trend following, that is a crowded carry trade. When grid sees a breakout above 162.6, I see a potential squeeze waiting to snap shut. The technicals look strong, but the flow data says the party is overpriced. A break above 162.6 might not lead to a smooth ride up. It could trigger a violent unwinding if the Fed hints at anything other than pure hawkishness.
But CIPHER, you're assuming the Fed stays neutral. The macro data doesn't allow for neutrality. With core PCE at 3.41% and CPI at 3.46%, the 10-year, 2-year yield curve is flat at 0.37 percentage points. There is no room for the carry trade to fail on a technical basis because the fundamental yield differential supports the dollar. The crowded short position is actually justified by the inflation data. Until that CPI number drops materially, the breakout above 162.6 is supported by hard macro evidence, not just algorithms.
Agree on the macro support pulse, but don't confuse support with immunity. My point is timing. Entering now at 162.368 is chasing the edge. The risk/reward favors waiting for the 162.6 confirmation. Once that pip is taken, the path of least resistance is clearer. But until then, we are in a high-tension zone where a single headline could reverse the flow.
And let's not ignore the VIX trap here. The VIX is at 18.77, which is historically low compared to the 14 over 100 fear and greed index. This means implied volatility is suppressing the cost of hedging for these breakouts. Markets are cheap to protect. When dollar-yen finally cracks 162.6 or worse, if it rejects sharply from 162.597, that low VIX will expand rapidly. You aren't just trading the currency pair. You are trading a volatility explosion that hasn't priced itself in yet.
So, we have grid flagging the technical breakout potential, CIPHER warning of the crowded short squeeze risk, and SPECTER pointing out that volatility is dangerously underpriced. Does anyone see a flaw in this tripartite view?
The flaw is in assuming the direction is solely dependent on the dollar. Grid is focused on the breakout, CIPHER on the squeeze, but neither is accounting for the counterflow in pound. While dollar-yen and euro-dollar are testing highs, cable is at 1.3462, lagging behind its own 5-day high of 1.3558. However, CIPHER, your data showed leveraged funds are strongly bullish on pound, adding 29K contracts week over week. This suggests that while the dollar is grinding higher against euro and yen, the smart money is already positioning for a divergence in the British pound. The breakout in dollar-yen might be the last gasp of broad dollar dominance before specific pairs like pound start decoupling.
That leads us directly to gold. Gold is trading at 4,025.13, up 0.74%, yet as noted in the headlines, it is under pressure. It is sandwiched between a 5-day high of 4,081.59 and today's low of 3,982.57. Given the extreme fear in equities, why is gold not rallying freely?
Structurally, gold is in a consolidation box. It's not breaking down, it's holding the mid-range between 3,982 and 4,081. The fact that it's up 0.74% despite the pressure narrative indicates buyers are stepping in at the lower band. But the lack of a breakout above 4,081 suggests that sellers are active at the top. Technically, this is a coiling pattern. Without a clear break above 4,081, we are stuck in a range-bound environment where upside is capped by yield sensitivity.
The cap is precisely the 3.46% CPI print. Gold competes with bonds for safe haven status. Because the 10-year, 2-year yield curve is flat at 0.37 percentage points, real yields remain positive. Investors don't need gold as much when they can earn a decent return on treasuries without taking on equity risk. The pressure isn't a sell-off, it's an opportunity cost. Until inflation falls towards the 2% target, gold's upside is mechanically restricted by the attractiveness of the US dollar bond market.
And look at the flows to confirm Pulse's point. Asset managers are holding a substantial net long in euro, plus 247,316, which often correlates with inflation hedges, but leveraged funds are dumping risk. The problem for gold is that the fear trade is currently split between dollar and yen shorts. Money is flowing into the dollar's liquidity, not necessarily into physical bullion. The pressure is simply the market finding a better place to park cash. The dollar index itself, which leveraged funds are bullish on via plus 4,438 net contracts.
Or, as I argued earlier, the market is wrong. The VIX at 18.77 suggests that no one is paying for protection against a further downside in risk assets. If equities do collapse harder, the opportunity cost argument Pulse makes disappears instantly. When panic sets in, correlation goes to 1. Gold's current consolidation is deceptive. It looks stable, but it's waiting for the VIX to catch up to the fear and greed index. If the VIX spikes from 18.77, gold's range expansion will be vertical, not horizontal.
So, grid sees a range, Pulse sees yield constraints, CIPHER sees dollar competition, and SPECTER sees a dormant bomb. The consensus seems to be that gold is in a holding pattern, waiting for a catalyst to break the 4,081 high or the 3,982 low. Finally, let's address the outlier in the G10 space, cable. It's trading at 1.3462, up 0.12%, but notably below its 5-day high of 1.3558. Why is the pound behaving differently from the euro and yen?
Because the positioning is radically different. As I mentioned, leveraged funds are adding 29,099 contracts to their pound longs, bringing the net position to plus 28,541. This is a direct contradiction to the broad risk-off sentiment. While everyone else is shorting euro and yen, the speculative crowd is going long pound. This suggests that the weak pound trade is exhausted among leveraged funds. They are betting on a UK economic rebound or a weaker US dollar, specifically against sterling, not broadly.
Technically, that makes sense. Cable is consolidating below 1.3558. It hasn't chased the dollar strength that pushed euro and yen down. This relative strength is a bullish divergence. If the 1.3558 level breaks, it could act as a launchpad, but currently it's acting as a lid. The chart shows a slower ascent compared to the frantic pace of dollar-yen. It's accumulating energy, not releasing it.
Be careful not to mistake absence of weakness for strength. The UK economy is also grappling with inflation, albeit a different mix. The global fearful sentiment at 14/100 usually drags everything down eventually. The pound longs are a contrarian bet that the Bank of England will be less dovish than the Fed. But with the US CPI at 3.46%, the Fed's hand is tied. If the Fed holds, sterling's appeal relies entirely on its own domestic data, which is currently overshadowed by the US macro dominance.
I'd add that pound is the wild card here. Because it's not part of the main dollar-long trade, it's less likely to suffer from the crowded short squeeze that CIPHER warned about in yen. But if the VIX expands, as SPECTER predicted, risk assets generally get sold. Pound is a semi-risk asset. If the 1.3558 level fails, it could see a sharper correction than the majors because the long positioning is thinner. It's a higher beta play in a low-volatility environment.
We've heard from Grid on the technical breakouts, CIPHER on the crowded flows, Pulse on the macro rigidity, and SPECTER on the volatility trap. Apex, tie this together. What is the dominant story for the remainder of the session?
The dominant story is a structural stalemate, driven by the conflict between geopolitical noise and monetary reality. Grid identified the technical pressure points at 162.6 in dollar-yen and 1.14826 in euro-dollar, but CIPHER correctly highlighted that the underlying flows are dangerously crowded in yen and euro shorts, creating a fragile foundation. Pulse anchored this by explaining that the 3.46% CPI and flat yield curve provide the fundamental fuel for dollar strength, making the breakouts technically plausible, but fundamentally dependent on no negative inflation surprises. SPECTER warning about the VIX at 18.77, being disconnected from the 14/100 fear and greed index, suggests that while the trend is long dollar, the risk management infrastructure is missing. The market is running on fumes, and the breakout above 162.6 or the rejection at 1.14826 will be the moment truth is revealed.
To summarize, we are watching dollar-yen approach 162.6 and euro-dollar test 1.14826, backed by sticky 3.46% inflation data, but threatened by extremely crowded leveraged fund positioning in yen and euro. Gold remains range-bound at 4,025.13, squeezed between safe haven demand and high real yields, while the VIX at 18.77 hides a potential volatility spike. Tomorrow, keep an eye on the labor market narrative as weekly jobless claims approach later this week. For ShadowQuant Forex Edition, I'm your narrator. Stay informed, stay cautious. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.